Hello, my name is Karen Monona, and I'm the Consumer Driven Health Plan Unit Manager for 90 Degree Benefits in Connecticut. I'd love to go over some of the benefit plans we have available for you. We offer many different choices in the office in Connecticut: flexible spending accounts, dependent care assistance, qualified transportation, ICRA, lifestyle benefits, and we can customize almost every single one of them. Flexible spending accounts. A flexible spending account is an employer-sponsored benefit that allows employees to set aside pre-tax payroll funds to help pay for eligible out-of-pocket medical, dental, and vision care expenses not covered by insurance. For a medical or healthcare flexible spending account, the employer determines the minimum a participant can contribute to the account per plan year. Usually, a good rule of thumb is $100 for the whole year. The IRS governs the maximum annual contributions a participant can make to an account. These limits are typically announced in the fourth quarter of the preceding calendar year. So in the fourth quarter of 2025, they should be releasing 2026 accounts. Election amounts can be changed annually during open enrollment or with a qualifying life event. That is it. That cannot be changed just because an employee wants to change their election. They stay for the whole year and they must be re-enrolled every year. There is no passive enrollment. There is no copy over option on a flexible spending account to the next plan year. Employee contributions are deducted from each paycheck pre-tax in equal installments throughout the year, and the employers may make contributions to the participants' FSA but are not required to. For the employer's medical FSA benefit, the IRS allows two different options in the event that the employee does not use up all their funds. One, a grace period. So instead of having a 12-month plan year, they allow an additional 2.5 months after the end date of the plan year to continue to incur expenses and use the funds. So in essence, they have a 14.5-month plan year for this. That's a grace period. The other is a medical carryover. A flexible spending account carryover allows 12 months to incur expenses without carryover amount regulated by the IRS. The maximum carryover amount is usually announced in the fourth quarter of the preceding calendar year. It allows you to take whatever that fourth quarter maximum amount is and move it forward into the new plan year of FSA. There's also two other variations to flexible spending accounts. One is a limited purpose FSA. Now, these can be used with high deductible health plans and in connection with a health savings account. The IRS does not allow anyone to contribute to a flexible spending account and a health savings account. So the options are a limited purpose FSA, which will reimburse for any dental and vision expenses only. And the employee can contribute to it just like a regular healthcare flexible spending account, but they're not eligible options for everything. Limited purpose post-deductible flexible spending account. This reimburses dental and vision expenses as well, just like a regular limited purpose, but it's a post-deductible FSA. If the employee hits their IRS minimum annual deductible amount, then they will be eligible to change that limited purpose post-deductible FSA to a regular healthcare FSA. Again, this must be used in conjunction with a high deductible health plan and an HSA. The second option is a dependent care account. These falls under the umbrella of an FSA plan. It is used to reimburse for any kind of services that include daycare, nursery school, anything that will help an employee go to work. Since the dependent care ruling is changed by the Big Beautiful Bill, the IRS will also be releasing dependent care maximum accounts in the fourth quarter of the preceding plan year. The new bill allows 2026 employees to elect $7,500 for their dependent care accounts. They must re-enroll in this every year as well. There is no passive enrollment. The dependent must be under the age of 13 years or physically, mentally incapable of caring for themselves and qualify as an employee dependent under a federal tax return. And again, this is so an employee or spouse can go to work. These will include daycare, nursery school, if it's for the primary purpose of childcare, before and after school care, summer day camps only, or adult daycare for anyone who is an IRS determined dependent. Overnight camps do not apply to this option. We also offer transit and parking flexible spending accounts. This is a month-to-month plan year where participants set aside pre-tax payroll contributions for travel expenses relating to and commuting to and from employment. Maximum monthly contribution and disbursement limits are IRS regulated and also released in the fourth quarter of the preceding plan year. Funds are disbursed via a debit card only. The IRS will prohibits any manual reimbursements. And contribution changes can be made throughout the year as an employee transit or parking needs change. Some employers offer also a post-tax transit and a post-tax parking. These account offer no additional employee tax savings, but prevent a debit card transaction from declining from a machine that will not accept partial funds. There are no limits as to how much can be contributed to a post-tax account. Health reimbursement arrangements. A health reimbursement arrangement, or an HRA, is an employer-funded benefit account that allows employees to use monies provided to pay for qualifying expenses, up to a fixed dollar amount per year. The employer has complete control over the plan design and is 100% customized by each and every single employer option. They determine the employer contribution amount, what expenses are reimbursable through the plan, whether it's medical insurance deductibles, copays, could include dental or vision expenses, could even do a 213D or FSA eligible option HRA. In other words, the employer would fund an HRA and they can use it for anything that can be used just like an FSA, only it's employer funds and not employee. Employers also control restrictions on the plan, but including but unlimited to whether the employee is responsible for a portion of expenses first before the HRA kicks in, if the plan will only reimburse a percentage of each eligible claim, and HRA funds are tax-free to the employees. Because all monies are HRA are employer funded, they normally remain with the employer and do not follow an employee upon termination. We do have an option that allows a HRA to carry over to a new plan year for active employees, but it's not generally used. There are different variations of health reimbursement arrangements. A new one is an ICHRA, an individual coverage health reimbursement arrangement. This is a benefit plan that allows employers to make pre-tax contribution for employees to use towards the cost of their own individual health insurance premiums and qualified expenses. We also offer an accepted benefit health reimbursement account, or an EBHRA. This benefit account, in which the employee does not participate in the employer's group health medical plan, they have waived the coverage, but the employer still wants to help contribute to the employee's out-of-pocket costs. They set aside a pre-tax fund amount to help pay for any of those out-of-pocket costs, and there is an IRS limit. And then there's a qualified small employer health reimbursement account. I call it QSERA. I don't know what others call it. This is a benefit plan that allows small business employers, which is under 50 employees, to make pre-tax contributions for employees to use towards their cost of individual health insurance premium and qualified medical expenses. Both the ICHRA and the QSERA have many different rules, so they can apply to many different companies. An individual coverage is that benefit, as we said, and can be used for the employee to go forth and choose their own individual health insurance plan and can be used to pay for the premiums as well as qualified health and medical expenses. Unlike traditional HRAs, which just reimburse medical expenses or insurance premiums for group plans, the ICHRAs are explicitly designed to work with an individual health insurance policy. They allow employees to choose their own ACA compliant insurance plans and offer more flexibility for both the employers and the employees. ICHRA participants must enroll in individualized coverage health plans that are specifically offered through the healthcare exchange or private carriers. Medicare Part A, B, and C are also eligible as well. We currently use eHealth as an option to help our participants and employees review the individual purchase plans and actually pay for them online themselves. A QSERA allows small employers to provide non-tax reimbursement of particular healthcare expenses like health insurance premiums, co-insurance to any employee and maintain a minimum essential coverage, including any individual marketplace plan. In many states, they allow small employers to provide their employees additional plan choices without managing group health plan coverage. To qualify for a QSARA or Qualified Small Employer Health Reimbursement Account, they have to have fewer than 50 full-time employees. They have to provide the arrangement on the same terms to all full-time employees. They must not offer a group health plan like SHOP coverage or an FSA. And they can actually decide what they want to contribute to their employees' healthcare costs, up to an annual maximum that is set by the IRS. Lifestyle spending accounts. A lifestyle spending account is an employer-funded post-tax spending account, promotes healthy habits, overall well-being, with eligible expenses and plan details completely customized by the employer. Employee benefits. It allows them the freedom to select their own expenses that meet their own needs and interests, and promotes a healthy lifestyle emotionally, physically, and financially. For employer benefits, it allows them to offer an innovative benefit that helps more effectively attract and retain talent. It incentivizes healthy behaviors that increase employee productivity and reduce insurance costs, as well as certain taxes, including payroll taxes. Now, how are reimbursements processed? Just to give you a little bit of an idea on this, we offer many different options. If an employer has and wants this option, we do offer a debit card option. Participants may access their funds by using their 90-degree benefits gray Visa debit card at the point of service. One card will allow them to access all different active account types at one time, at any time, actually. So they only need to carry one card if they have multiple accounts. Eligible plan expenses can be submitted manually for reimbursement. This, of course, is with the exception of transit and parking fees, because per the IRS, they can only be disbursed via debit card. Employees can submit manually for reimbursement as long as we have the correct documentation. So manual claim submissions can be emailed, faxed, regular mailed, or uploaded onto the WEX employee portal or their mobile app. And they can be paid by a check or, if the employer chooses, a direct deposit to the participant. We also offer a provider payment plan. So in other words, the check would be pulled from the employer's bank account and it would be processed and sent directly to the provider. Thank you so much for joining us. Just to give you a little idea, this is just some of the basic information on the CDHP plans that we do offer. We do have a lot more information and a lot more benefit customization allowed. So if you have any questions, please don't hesitate to reach out.